sales trends are just getting worse. That's your Redbook retail index, which is an index of sales trends for 80 retailers. It's just getting worse. The credit card data, especially since the banking crisis, is getting worse. The traffic data that we track along with Howard and his team, for the retailers, it's getting worse in almost every category. And the conversations that I'm having with institutional clients over the past 2 weeks, we've been doing a lot of marketing. People want to know what to buy. And they're very short conversations because I can't give them anything. Like you and I have joked about, Keith, like most of my longs are probably shorts. Yes, I can point to a couple of names where I think earnings expectations have bottomed out, but most companies are guiding to a hockey stick in 2023. And that hockey stick is probably too steep, but most importantly, the base is just wrong. In that people aren't expecting, at least I don't think they are, this really big guy down that we're going to see in the May earnings season for retail. I say May because if you don't know, retailers are on a January fiscal year. So we get earnings a month later than everybody else does. But I really think it's going to be a complete bloodbath out there. I think we're going to see a lot of pre-announcements. Mainly because of top line weakness and deleveraging SG&A. I'm not going to go through all of my tickers here. We'll talk about them more on the retail show at 11 a.m. when we're in the studio. But people they're like chasing the FOMO. There's just, to use your words. I think my space is like the poster child for it, where people don't want to miss the rip in these stocks, but they're not looking at the magnitude of earnings that have to come down like in a really big way. I'm sorry, I think I misstated Howard. He said casual dining sales are down, not positive. My bad, Howard. So look, that's additional proof that the consumer is in bad shape. But in the world of retail, they look really bad.
It was only 2 weeks ago that the XRT was on its ass. Like, it's not like, this very short-term FOMO largely has to do with the institutional reality of performance chasing. So when your boss is behind, chasing the ace or behind the 7 stocks that are essentially equating to the whole stock market move, then there's pressure on you as an analyst or as a PM to keep up. This is exactly what happened in 2001 and by the end of the first quarter and in 2008 for that matter. So it's not like it's never happened before. This is 100% of the time that it happens, and in this case, it's just happening in a much more bubble cap or narrower, frame. It's like, again, 2 weeks ago, what did Amazon announce? That they're firing more people, stocks on its ass, and then all of a sudden, 2 weeks later, you get your bailout from both OPEC and the Fed and whoever else, and it's all like, I got to chase. So it's a really, you could have highlighted, by the way, the Citigroup put out their credit card data. It was just like literally a cannonball to the downside in March. So again, OPEC doesn't come up with a surprise if that isn't happening from a demand perspective. I can't say that enough times. I know a lot of people on CNBC or whatever won't connect that, the most basic dot on an I today. But anyway, that's what I had to say about that.
Hey there, Hedgeye Nation, or if you're not part of Hedgeye Nation, thanks for watching Hedgeye on YouTube. If you haven't already, make sure to click on the button below there. Subscribe to our YouTube page. You can also follow the link in the description to our website to get even more great investing content.